Welcome back to another weekly episode, guys. So, I hope you went through the midweek update I gave out on Instagram. That is the probable path that the markets can take. So, in this particular episode, I'll keep it short. I'll just give a quick technical update of what is going on in the market and a couple of things about how you should be thinking in a bear market, if that is what you want to call it, and how you need to check for which pockets of strength are emerging and what to do about them. So the first thing I would begin with is the whole notion of a bear market. Now you would be hearing a lot that our markets have entered a phase that is a bearish phase. A lot of stocks have corrected. Typically, if you see when a market or an index drops by something like 20% or more, that is from its recent high, that is what is categorized as a bear market. But the problem with bear market is that emotionally it feels so much worse. The uncertainty around it, the losses, and most of the people actually have an instinct to flee from the market. That is just quit trading and investing and come back when the market settles down. However, if you understand the true nature of bear market, then it can actually help you navigate that tricky phase more wisely. So first what I will do is I'll just explain what is there on the chart. Simple candlesticks. This is a 50 DMA, this is 200 DMA, this is relative strength, that is ratio chart against Nifty 50. Now, I have included the 200 DMA because you're hearing a lot of noise about the death cross happening in the market. Death cross happens when the 50 DMA goes below the 200 DMA. So it happened here in the past, it happened here, somewhere here also. I hope you get the point. All right. Because this is a big talking point these days. So what I see on small cap 250, again, a pivot breakdown has happened well below 50 DMA. Market is going to take some time to repair its structure. There are no two ways about it. Quickly, I'll go through all the sector charts. Consumption index, the story is the same. The death cross has happened. Small cap 100, though the death cross hasn't happened, price is well below the 50 200 DMA. Look at the retracement in recent times. This retracement is just not great. It's just not great because look at the ferocity of these candles. Look at the range. Look at the kind of expansion that has happened. And look at this. This is not a great retracement yet. It still tells you that the overall conditions are not right. I'll quickly flip through charts. This is mid small 400. Again, look at the quality of retracement, just not great. Mid cap 150, mid cap 50. The story is the same. This is Nifty Total Market Index. The chart actually I had explained on Instagram. And what I feel, if you look at what Total Market Index has done, it has fallen about 13.7% from the recent highs, which is a great number. It's a great number because underneath you will be finding a lot of stocks that have corrected over 25-30%. All right. So the broader market has gone through a much deeper and a much painful kind of a correction. A lot of portfolios will be hit, whereas the headline indices have still not, according to technical classification, reached the minus 20-25% mark, which actually is classified as a bear market. But underneath, a lot of stocks have hit the 20-25-30% mark. And yes, those structures are obviously not great. Look at the micro cap 250. Again, very poor retracement, but at least this index is above 200 DMA. FMCG, just no strength. Consumer durables, mid cap 100, mid cap select. This is MNC. I'll quickly flip through charts, guys. Nifty IT, it was showing promise here, but look at how reversal has happened. This is why, people who went behind the index at this level, I won't say it's a mistake, but always remember in such kind of markets, even a small kind of breakout has more tendency to fail. This is the large mid cap 250. It's the same structure, guys, across all sectors except pharma, except healthcare, and except IT, which in itself is actually a defensive undertone in the market. Look at Nifty Next 50. Look at the kind of fall that has happened. Look at the retracement. I'll come to some specific points in a bit. Look at the Nifty Metals. Media, I generally don't track. Commodities, this is India Digital along with IT. It is still in a decent structure. This is Nifty Service Sector. This is private sector banks, energy index. Look at what has happened to this particular index. Death cross happened and prices just steadily moved lower. This is Nifty Bank, Nifty Auto, oil and gas, PSU Bank, financial services, CPSE, the darling of the previous cycle. And now comes the bit I want to talk about. This is Nifty 100. Look at the deterioration of relative strength. This is Nifty 200. And now look at Nifty 100. The relative decline in broader market is still lesser when you compare it with the top 200 stocks, which tells you that this is a fall that has happened on back of those stocks where FII ownership has been high. And this trend will continue. And don't make the mistake of thinking that this is only specific to India. In the last week's update, I told you this is a global trend that is emerging. I'll just show you something. Look at the Russell 2000. I'll quickly come to the emerging market charts first. Just give me 1 second. Look at the emerging market index. Ever since Nifty also topped out, emerging market index has fallen 16% from the highs. Nifty is still down 12.7%. You look at emerging market X, something like a Chinese market, this is down about again 15 odd percent. China itself has retraced from the peak. Now look at the retracement. This is a 27% retracement. And a lot of things can be attributed to what the dollar index is doing. Now here, if you see the cross, this is the golden cross. When 50 DMA cuts 200 DMA from the downside, this is a golden cross. And supposedly price tends to rally once this happens. Now the efficacy of this has to be back tested. I personally am not a big fan of the death cross or the golden cross. Ultimately, it's just a moving average. But a lot of things that are currently going on in the emerging market world is because of dollar index staging a breakout and having a vertical move from 100 to something like 110. That is a 10% move. And you can of course see what has happened to equity markets. Now this is not the first time. The previous painful phase that we had, now look at this chart and now look at Nifty 50. This correction that we had, in this correction, dollar index actually went from something like 90 to 114, which is again a move about 20%. If a 20% move is coming, if dollar index is heading towards 120, 125 or 121, I don't know what the number is, then of course emerging market is headed for more pain. And that is what I had posted midweek on the Instagram chart also. That because the sentiment is so bearish in our market and the positioning is happening on the one side, that is, people are more inclined to short sell, it's entirely possible that what we can do is that we first go and retest probably a 50 DMA or probably take out this pivot, then form one range. And if the dollar index does not begin the retracement, then we can again go out and probably come lower within this particular candle. A lot of sectors are breaching this candle low also. Why this candle is important? Because this is the low that got formed on the election day result. Again, recollect the previous discussion we had last week. You always need to analyze the market from the most logical point. So this is the broad range that I had given for 2025 and this still remains valid. If you look at the global markets, you look at DAX, lifetime high, you look at S&P 500, some correction is going on, but nothing is wrong. You look at FTSE, you look at Dow Jones, you look at Japanese market. Japanese market, obviously, it's not doing that well. And a lot will depend upon what the central bank does. Now, the important part, for the next 15 odd days, you're entering a period that is going to determine what is going to happen in the next 4-5 months. My guess, and again, this is a guess that I have, is that we won't see significant recovery till the first half of 2025. That is, we are going to remain in challenging times between Jan to June, July 2025. And that is when we can start seeing some momentum coming back in the market. There are some critical events that are happening. Monday, President Trump is getting, sworn in. Then you have the Fed meet, you have RBI meet, you have our budget. So market is bound to be very volatile right now. But I have a message for you. As the title of this video says, I remain bullish on the market. I remain bullish on the market because history teaches you that being bullish during tough times is what helps you move forward in terms of account growth in a period of 18 to 24 months. Now, do not forget that bear markets actually are a natural part of market cycle. Bear markets are not anomalies. They are actually inevitabilities that exist during the vast universe of stock market. And history actually shows us that no bull market lasts forever. But it is actually same for bear markets as well. Every bear market, guys, in general has been followed by recovery, and every downturn, do not forget, has paved the way for a new uptrend. So you got to understand that here the entire role is of your perspective. A bear market, usually is often referred to as a time of something like a doom and gloom. But what I would like to tell you, is that you need to view it differently. What if you tell your mind that a bear market is less about loss but more about the opportunity that lies in front of you? All right? What if a bear market is not a time to run away from the market but a time to build your long term or even a positional portfolio in the market? So there are key things that a trader has to do when it comes to a bear market. Number one, you got to stay resilient. What does it mean? Resilience usually has three aspects. Number one is discipline, number two is patience, and number three is research. Discipline means you avoid making emotional decisions and you stick to whatever strategy you have. Patience means recognizing that recovery will take time. The markets always reward those who actually stay the course. Stay the course means whatever is your trading and investing plan, even in tough periods, you get to follow that. And the third part is research. Research means during this phase, you have to repeat the drill. You have to shortlist those stocks that are breaking out, have strong relative strength with respect to Nifty or Nifty 500, and keep putting them in your watch list. Now, I remain bullish on the market does not mean I'm committing a lot of money in the market. Those are two separate things. I can be bullish, but I can be ultra conservative in my position size, which I already am since the beginning of the year. Even in April, when I give you an update, or March, or Feb, and the market has fallen another 10%, I will still tell you I remain super bullish on markets. But it does not mean that I'm committing a lot of money. I will commit money when I see the right kind of structures getting formed in them. And let me tell you one thing, a lot of market participants actually enjoy bull markets. Whereas in my own personal opinion, it is actually the bear markets that are more valuable. And bear markets are actually serving an essential purpose. Again, I don't want to use the word bear market because technically index wise we are not, but because it is becoming a theme that our markets and the global markets, some pockets of global markets are not doing well and it's entering a bearish territory. That is why I'm giving these examples to you. So the bear market, in my view, or a corrective kind of market is very important, mainly from three kind of subpoints. The first one is a bear market will correct the excesses from bull markets. That is, whatever high valuations were going on, market brings it back to reality, or rather gives it a reality check. Number two, bear markets or a corrective market also tests the conviction of traders and investors, and it separates those who understand market cycles from those who don't. This is an important point. And third and most important, a corrective and a bear market creates tremendous amount of opportunities, allowing you to position yourself for the next phase of growth. Never forget this. If you were not there during this phase of the market, you would have not traded this. If you were not there here, you would not capture this. If you were not participating or sitting on the sidelines and tracking the market when it was crashing in COVID, you wouldn't have recognized that the recovery has begun. Most of the people, I will tell you, in stock markets, check the fund data also have started coming in here. This entire leg was missed. Why? Because this is a painful period, and this is where majority of people do not pay attention. So what you should be doing as an investor or trader? See, there are a couple of things that I have learned. Number one, you need to stay informed. How do you stay informed? I've always told you, keep tracking the market with respect to 50 DMA and 200 DMA. You won't go wrong many a times. As of now, both Nifty 500, Nifty 50, Nifty 100, Nifty 200 are decisively below 50 and 200 DMA. This tells you that you got to be conservative. If you usually buy 100 shares of a stock that breaks out, buy only 10 and see if it is working. That is how you preserve your capital. The second thing I would ask you to do is rebalance and strategize, which means the example that I gave you. If usually in a breakout trade, you take 2% risk on account size and you take that particular trade, because we are in a conservative zone, risk per trade should be brought down to something like 0.25% per trade or 0.5% per trade. That is in terms of calculating position size. The third thing I'll tell you is that have a mindset of seizing opportunities. Now I want to pull up this chart. Now this chart, if you see, this chart is of Dow Jones that goes back a 30-year period interval. That is, I've broken down 125 year of data. Now this is 1900 to 1930. You know, we had tough phases, but all these rallies that you're seeing, you're getting tremendous opportunities in the stock market. In a period of 30 years, Dow Jones went from something like 63 to the peak of something like 400. Take next 30-year period when you had the Great Depression. Look at where market ended in the next 30 years. Take another 30 years, 1962 to 1992, and then another 30 years, 1992 to where we are today. The message is very clear. Broad term direction of stock markets is always up. In between, you get these massive bouts of correction and volatility where you have to simply step aside and wait for the right opportunity. A lot of people who were trading in 1987 or 1970 or 1965 or 1950, they haven't shared their information. But if you ask 9 out of 10 people, they will tell you that they were not paying attention during phases where stock markets were correcting and doing this. And when eventually this happened, this is where they started coming. So the lesson is you have to seize every opportunity in terms of mindset. Your mindset has to be a long-term bullish player in the market. You can short sell if you want to. You can buy puts here or there if you want to. If you want to satisfy that urge to be in the market all the time. But do not lose the sight. Do not lose the sight of the changes that are happening in the world, for the good and for the bad also. But in general, because of how humans are built, because of how evolution happens, because of how technology is evolving, because of how industries are changing, pockets will always exist that will continue to take the market higher even after it falls 10, 15, 20%. That is how it is. And the last point that I will tell you in this is that you need to stay calm. Do not forget that every bear market ends, and those who remain steady often turn out to be the biggest winners in the next growth cycle that plays out. So when it comes to you moving forward in 2025, you have to recognize the reality. The reality today is that majority of broader market indices are below 50 and 200 DMA, which means you have to be ultra conservative. But from a medium to long term point of view, you have to tell yourself that bear markets are part of the game. It's during these times that you separate impatient traders from the ones who are disciplined and have immense patience. Else, it would be easy for everyone to make money. Never forget this. And do not forget that every bear market or every corrective market that comes about, it is actually an opportunity to buy the future at discount. What I mean by this is that in September or October, if someone would have told you that you can buy X 20%, 25% lower from where it was, you would have grabbed that opportunity from both hands. But now that you are seeing a broader market like Nifty 500, which has corrected 13, 14%, your mind is now telling you that this could get more worse as time progresses. And it could, guys. That is not the point. But the point is to always think positively in stock markets, always look for stability, always look for signs that you can identify a probable bottom. That bottom gets confirmed by price moving above 50, 200 DMA, sustaining, forming a range, and then again a beautiful rally plays out. It's not that this has only happened after COVID. You take historical examples. These are beautiful trending periods that emerge above 50 and 200 DMA, and this is where you can do exceptionally well in the stock market. So be conservative today, be defensive today, be more watchful, but do not forget that bear markets and corrective markets are a massive opportunity for those who do homework and prepare for the next growth phase of the stock market. All right, do follow me on Insta. I'll give out a midweek update if it's required, either on a Wednesday or Tuesday. Else, I'll see you next week. Take care, be safe, and have a wonderful weekend.